Hi everyone, thanks for joining us today's session, which is a joint financial wellbeing webinar to talk you through how you can plan for the unexpected. Now, before we get into today's session, I'd like to start by introducing ourselves. My name is Laura Pearson. I'm a chartered financial planner and the director of Staunton Rose Financial Planning. Now, I set up this business with the mission to cut through the jargon and empower people to make decisions that will positively affect their financial future through straightforward, no-nonsense financial planning. And I've also got Tom Rimmington, who's going to be joining the webinar today, who's a solicitor at Peter Edwards Law, specialising in wills and incapacity. So we will be running today's session together, and you will receive an email with a webinar recording and also a link to a very short survey. There's like 3 questions on it, so it's extremely short. But that survey will also give you the opportunity to request a call either directly with me or directly with Tom if you want to talk about anything on a one-to-one basis further. So if there is anything that generates thoughts and questions, please either pop them in the Q&A box and we will still pick them up later on and reply directly to you, or just wait until that email comes through and click on the survey and we can set up a call and talk to you directly at that point. So let's get into today's session today, which is entitled Financial Wellbeing, Planning for the Unexpected. So what does that mean? Well, let's start with the first part, financial wellbeing. And to me, what that means is having control over my day-to-day and month-to-month finances. It means having the capacity to absorb a financial shock, something that happens that I'm not expecting. And this is something that would hit my finances and mean I can't pay my bills, or I need a lump sum of money somewhere quickly. Financial well-being to me is also meaning that I'm on track to meet my financial goals and I feel positive about the future. And it also means being able to make choices that allow me to enjoy life. So financial freedom and financial well-being is not just about being super wealthy and being in a position where money is no object. It's all about whatever puts you in the position where you feel comfortable with these goals and whatever it is that's important to you. So today we will be focusing on this particular element of financial well-being, which is having the capacity to absorb a financial shock. So something that happens to you that you aren't expecting. So let's take a look at the second part of our title today, so planning for the unexpected. So today we will be focusing on some events that can and do happen every day in people's lives that have the ability to really knock you off your feet financially and have the potential to cause serious damage to your well-being and that of your family. Now, I'll be honest, this is not the cheeriest of webinars, and some of what we saw today is pretty grim, pretty doom and gloom. But the people who aren't naive enough to think it'll never happen to me are the ones that come out on top in these situations. So hopefully we can help you prepare to be always on top if the unexpected happens. And hopefully today's session will help you with that. So what kind of unexpected events are we going to talk about today? Well, I'm going to kick us off by looking at divorce and separation, the potential for a serious illness changing your life and being and needing a lump sum of money to cover medical costs or other costs, or not being able to work. I'm going to look at what happens if you have an accident or an illness which stops your income and stops you from earning. And I'm also going to look at the potential of you or a loved one dying sooner than expected. So I told you it was all pretty cheery stuff, didn't I? Tom's then going to pick up a bit later on and focus on what you can do to plan for the event of becoming incapacitated and being unable to make decisions for yourself in the same way that you could before. He's also going to look at what you can do now to prepare yourself if you or a loved one require residential or long-term care. And Tom's going to finish off with tying back into making sure if you or a loved one die before you expect to, that you are prepared and have things in place to ensure this awful time does not cause any further stress than it needs to. So, if we focus on divorce in the UK, the facts taken from the Office of National Statistics tell us that as of 2021, the overall divorce rate in the UK is 42%. So 42% of marriages end in divorce. In 2021, there were actually 9.6% more divorces than in 2020. Now, of course, due to COVID, like everything else in the last few years, these figures may be skewed to some of the family courts not being open, but it may also be that there are more marriages breaking down due to the pressure of COVID and the financial impacts that this has had, or even just spending too much time together on lockdowns. So finances can really play a big part in relationships. Poor financial planning or management or unexpected events like the things I've mentioned previously add stress to finances and can cause relationships to break down. And of course, when they do break down, the financial impact of having to split one household into two can be really severe. The graph here shows the divorce rates depending on the year of marriage. And it's quite clear to see a steady increase between those married around the year of 1965, which is this dark blue line at the bottom, and to those who married in 1995, which is this dark green line at the top. And while it's still early days for those people who married in 2005, which is represented by this kind of little green line in the middle, these divorce rates are already at 30% for people married in 2005, and we're not even 20 years into their marriage yet. So these are big numbers and increasing. So how can this impact us financially, and what can we do about it? Well, nobody wants to go into a marriage thinking about separation or divorce, but there are some key differences between the couples that come out of these very tough times in a strong position and those who don't. And most of the time, it comes down to those who have made a positive election to save for the future and set up investments like stocks and shares, ISAs, pensions, and property, whether that be in their individual names or in their married names. And the people who do this well generally come out of these situations, such as divorce and separation, in a much better way. So let's look at the next 3 unexpected events that could really knock us off our feet in many ways, but particularly financially. Getting a serious illness, you or your partner dying sooner than expected, and having an accident that stops you from working. So what are the chances of this happening? And many people really do think it won't happen to me. But unfortunately, that just isn't the case for everyone. Legal in General, one of the biggest UK financial institutions and a major global investor, have put together a calculator called What Are the Chances? And this looks at the chances of these events occurring to you and or your partner based on some main demographic characteristics. Now, if anyone wants to look at what this looks like for you or your partner individually, again, please click on that survey link, leave your details, and I'll give you a call and we can talk through this as part of your planning process. But I've done this today for me, and let's have a look at my results. So this morning I completed the calculator and put my details in. So I'm 41, I'm a non-smoker, female, hopefully that's obvious. And I want to retire at 60. That's my goal. I want to get retired at 60. My partner, Paul, however, is a few years younger than me. He's 38, but he is a smoker. And Paul is probably likely to work till he's about 65 before he retires. So what does that mean? So we can see the results showing for the chances of one of these things happen to us both as a collective, or we can look and separate those individually. But let's look at the chances of one of these things happen to both of us. So this tells us, the results tell us that if we look at us both together, there is a 56.6% chance of one of us being unable to work for 1 month or more before we retire. There's a 32.1% chance of one of us suffering a serious or critical illness before we retire. And there's a 13.4% chance of one of us dying before we retire. So if you were depressed earlier on when I started talking about all these things that can happen, imagine how I felt this morning doing this. It's not very nice. We can split these off. These are pretty compelling statistics, and they are backed by science. So anybody who's dubious about these results, they are backed by science and analytics. And I'm happy to share Legal in General's website where you can see how that's all put together and where these numbers come from. And just in case you're still thinking, oh, it definitely won't happen to me, let's focus specifically on those serious illnesses, as sadly statistics tell us otherwise. Let's look at some facts. So, according to cancerresearch.co.uk, 1 in 2 people in the UK will be diagnosed with cancer at some point in their lifetime. It means that somebody in the UK is diagnosed with cancer every 90 seconds. Now, on a slightly more positive note, 50% of those people who go on to survive cancer will go on to survive cancer for 10 years or more. But some of those people will have some life-altering consequences of that illness. And it's not just cancer that we need to be concerned about when we're thinking about serious or critical illnesses. If we look at the reasons why people claim on critical illness insurance, in their lifetime, we can see that 47% of men will claim for cancer compared to 71% of women. But actually, men claim a lot more for heart attack, with 19% of men claiming on a critical illness policy, doing so because they've had a heart attack. For stroke, it's 9.4% of men, 5.3% of women. And then there's other illnesses such as multiple sclerosis, Parkinson's disease, brain tumours, and the list goes on. And if we look at this by age, we can see that we are most likely to suffer a serious illness between the ages of 50 and 59, but we're still very likely to suffer an illness between the ages of 40 and 49, particularly if you're female. And in many of these situations, these people that we're talking about here, these people who make up these statistics, probably also thought it won't happen to me. So let's move away from serious illness and start looking at other things that could prevent you from working and paying your bills. This graph has been put together by the Office of National Statistics, showing the reason for absenteeism in the workplace being predominantly due to an injury or illness, followed by musculoskeletal problems, so things like a bad back, joint issues. The third biggest cause is mental health conditions, like stress and anxiety and depression. And that particular illness has become more and more evident in recent years. And actually, in 2021, in this green bar here, you can see it accounted for the main reason people had to take time off work. This is further backed up by income protection claims statistics from Aviva, one of the largest UK insurers, who show that 37% of their claims for income protection were due to being off work due to musculoskeletal problems. So those back pains, those joint issues. And 21% are with mental health issues. 11% being cancer that we talked about earlier. They also show that the average age of claiming for income protection, so being unable to work and claiming income protection, is 44. And in general, people are overwhelmingly more likely to be off work due to an accident or illness between the ages of 40 and 59. And what about early death? Well, death rates are extremely important to discuss when planning financially, as of course we must plan for the potential impact of dying earlier than expected and leaving our loved ones without our income, or not being able to pay for childcare, mortgages, and other costs of living. But likewise, living longer than expected can also cause us financial stress, with more and more people now dying later in life, meaning that more and more people are running out of money in retirement and seeing an increase in their cost of living later on in life. due to needing some kind of care requirement, whether that be in a residential care setting or at home. So I'm going to talk a little bit about this later on in the webinar. He's also going to talk a little bit about planning for the event of dying early. So, without taking you on that pretty depressing journey, I am hoping that we don't have anyone left on the call who's still sitting there thinking it definitely won't happen to me. And whilst, of course, we absolutely hope that none of this happens to you, it's really time to start getting real and making sure you are prepared financially if it does. There are several ways we can plan for the financial shocks caused by the consequences of those events that I've talked through. And the first I'm going to talk to you about is basic savings and investments. Now, with your money, you should always be looking to split it into three pots, that being your day-to-day spending money, your near future plans, your near future spending and your emergency fund, and then your long-term plans. So anything that's kind of over 5 years away, or retirement being probably the main goal for a lot of us as well. So we have our income going into our day-to-day part, which is where we pay for our cost of living, so mortgage, rent, bills, shopping, and other day-to-day spending. And following this, you should work out what leftover cash you have. And for some people, obviously, this will be more than others, but working back through your day-to-day part every couple of months to see if there's any way you can reduce your spending is a task we all should be doing to keep on top of our financial well-being and remain in control. Whatever leftover cash you have, then this should be split, with part of this being set aside to cover the plans that you have in the near future. So things like holidays, home improvements, maybe the kids' university funds, or whatever that might be. And as well as this, you need to be looking to build up an emergency fund, which can help with some of those smaller financial shocks that we've already talked about. So what I mean here is a pot of instantly accessible cash, which you can get at if you need to, not money that's invested, potentially in a savings account, but not in an invested account. So how much is the right amount in the emergency fund? Well, there's no right or wrong answer to that really, but as a guide, we'd normally say something like 3 to 6 months of expenditure, which could top up your income following any short-term absences from work, or give you some cash if you need some cash for boiler issues or car repairs or something like that, something else that you haven't planned for. The rest of your leftover cash should then be put towards these longer term plans, so things that are 5 years or more ahead, such as retirement. And it's this money that should be invested to keep up and grow above inflation in the long term. So we can use investment wrappers like pensions, stocks and shares, ISAs, general investments accounts to put the money into. I'm not going to go into the merits of all these different types of accounts on today's webinar, but I do have other webinars which look at these in more detail later. And if you follow our socials, follow our website, www.sortandrose.co.uk, you'll be able to see how you can register for those. Or, of course, you can still book in for that one-to-one session with me after today's call, and we can talk about what's right for you as an individual. But you can invest in any of these accounts, so it doesn't really matter. The main thing is that the sooner you start on these investments, the better, as they've got more time to grow due to the benefit of compound growth, compound investment growth over time. And I'm going to show you a short video now, which explains that in more detail.
We all know that get-rich-quick schemes rarely end in a fortune. But the good news is you don't need a secret formula or gimmicky investment tool to boost your savings. All you need is time, the most powerful tool you have. Let's assume that starting today, you decide to save £150 a month. After 10 years, you've saved £18,000 and you stop adding more money, but leave the rest invested. Now let's say you told a friend at the start and tried to get them to do the same. They had other priorities, a big holiday, a new kitchen, so decided saving could wait. All in all, 15 years pass before they decide to take your advice and start saving £150 a month. They feel they can save for longer, so they carry on saving monthly for the next 25 years, putting away £45,000 in total, 2.5 times as much as you. Over the long term, you might hope your investments would grow by 5% a year on average. This, of course, is not guaranteed, but for this example, we'll assume both you and your friend enjoyed these returns. 40 years have now passed since you first started saving. Who do you think is better off? The obvious answer is your friend. They've saved much more. But the incredible power of compounding means that's not the case. You have £100,480. This cost you £18,000, which means your investments have grown by £82,480. Whereas your friend has £88,218, but it cost them £45,000, so their investments have only grown by £43,218. They have £12,262 less than you, despite saving £27,000 more. So, by waiting 15 years, they are £39,262 worse off than you, despite saving for longer. Remember that this is just an example, not a projection. So the best time to have started saving is 10 years ago, but the next best time is today. You can start regular savings with as little as £25 a month.
Okay, so hopefully this is starting to make sense as to why you should start building your savings and investments as early as possible, so it can cover and get you in a better position if you do need that lump sum of money, if you do lose your income, if you do get diagnosed with a serious illness, or if unfortunately your marriage ends in divorce. But building your savings and investments as early as possible is great, but it's still going to take some time to build up. And to cover serious unexpected events like death or serious illness where we need money quickly, the way we do that and the way we cover for that is to make sure that we're insured. So I'm just going to briefly touch on the different kinds of insurances that you can help to protect us for some of the things that we've just talked about today. So we can set up life insurance, which pays out a lump sum if you or your partner or your business partner die. So you can use it to pay off mortgages, replace income that person brought to the table, or replace the skills brought to the business if the business partner passes away. So there's lots of different ways you can do that with life cover. So for a serious illness, a critical illness like we talked before, so something like being diagnosed with cancer or one of those other horrible illnesses that we talked about earlier, you'll need to have a lump sum of cash, and a critical illness policy will do that, paying you out that lump sum when you need it. Now, you might use this to pay bills, pay off your mortgage again, or to pay for treatment. So you may need treatment outside of the NHS, which you want to pay for at that time. And many people actually use the critical illness cover to adapt their lifestyle after their illness. So critical illness policies pay out 14 days after diagnosis, so you have the money quickly when you need it. However, a lot of people do go on to recover from those illnesses, and if they've had that lump sum of money and they haven't needed to spend it on treatment, they may change their lifestyle after their illness if they need to. They may adapt the property if the illness has caused them to need to, or they may just enjoy the fact that they're now mortgage free and move on with their lives. Critical illness policy will also cover children as well. So it does mean that if you've got children, usually up to the age of 23, and they are diagnosed with one of those serious illnesses that we talked about, the critical illness policy will pay out a lump sum again for you to pay for treatment for them, or for you to take some time off work without having that burden of needing to earn that income during that period of time. It doesn't affect your own policy. Your own policy still exists. It's usually an additional payment with many insurers. And then there's income protection, so up at the top here. So many people insure their pets, the cars, the mobile phones, but they forget to insure the thing that's really important and pays for all of that. And that's the income you bring into your household month in and month out. And insuring this means if you're unable to work, you will still continue to receive that income after your sick pay from your employer stops, if you've got any sick pay from your employer, because not all of them will give it to you anyway. But if you do get some sick pay for your employer, great. Your income protection would just kick in after that. So hopefully today, although I've took you on that pretty miserable journey to start off with, we've talked about some good solutions to make sure that you're prepared for the unexpected if it does happen to you financially. And what I'm going to do now is I'm going to hand over to Tom, who's going to launch us into the next part of our session.
Hello, welcome along to this webinar about wills and lasting powers of attorney. Thank you for attending this meeting. I'm going to be talking about protecting your family and property when the unexpected arises, and obviously with particular emphasis on wills and lasting powers of attorney. Just moving on to the next slide. This is a statistic I've obtained that it's amazing that 50% of adults in the UK have not made a will. That is a staggering statistic. And in my experience in practice, it's difficult to put my finger on the reason for that. But I think it comes down to it's one of the easiest things to put off in life. Like a rainy day event. It's easy to shelve it and not do anything about it. And I had a client recently in his 50s who said to me that he wasn't ready to do a will because he wasn't ready for it yet, meaning that he wasn't ready to die yet. So that's just an example of some of the attitudes that people have. But in my opinion, this is a way of getting your house in order, making sure your family are protected and they receive their benefit. So just going on to the next slide. So what are the reasons for making a will? One of the main reasons is that you can decide who will benefit from your estate. So typically that's your loved ones, your husband or wife, partner, and then if they've died, then if any of those people have died, so as I said, if the husband or wife has died, then the children will act as substitutes, and then you can think of other members of the family as well. So this is your chance to put it in writing and to make sure everything is covered. What else does a will do? Well, a will also nominates who's going to manage your estate on death. These people are called your executors. You might have heard of this before. It doesn't matter if you're a beneficiary, you can be an executor as well. Just occasionally I recommend different people if I think there's going to be a dispute or a conflict of interest. But generally speaking, it's crucial to think of who's going to manage your estate, so you know who's going to deal with it when you pass away. Another point is to consider is who's going to look after your minor children. So that's children under the age of 18. If, for example, your partner or your husband or wife died before you and they're still minors, there you need to think about guardians to look after them, and that's covered in the will. Finally, probably one of the most important is that after doing a will, like the guy I was talking about at the beginning, doing a will gives you peace of mind because you've got all these things sorted, they're all in order. You know who's going to deal with your estate, and you know who your estate is going to. So what happens if you don't make a will? What are the problems with that? I'm going to give you two examples here of the problems encountered. Remember, if you don't make a will and you then die, you're subject to the rules of intestacy. So that's the rules when you die without making a will, a set of rules that are not as good as making a will itself, but they go some way to help you in those circumstances. Let's take this example of the photo. So in the photo is Jill Dando. I don't know whether you remember her, but she was a well-known newsreader for the BBC. She also presented a programme called Crime Watch, another BBC programme. She very sadly died at the age of 37. She was very sadly assassinated or killed at her front door. And it was very sad. She died immediately. At that time, she was engaged to her partner, and that's her partner in the photo there. They built up a lovely relationship, and she died in April, and they were due to get married in September. Sadly, she had not made a will, and so in this case, she had to rely on the intestacy rules that I've talked about before. So despite her dedication and love for her partner, in this case, under the rules, applying those to this case, it was her father who was the sole beneficiary. He received the sum of £607,000 in her estate. Her partner, in that photo, he received nothing at all. So that's the situation that I'm sure we all want to avoid. Obviously, it's a very tragic situation, but it just brings home the fact that if you're single, it's crucial that you get your affairs in order and to make a will. You can always change it if your circumstances change, but it's important to have one in place. The second example of where the intestacy rules, as I said, that's where you die without a will, let you down, is in the situation where you have a larger estate, say, for example, an estate above £350,000. So the person that's died that's all the money that they have, £350,000. Now, the problem with the intestacy rules is that it limits the amount that the surviving husband or wife receives. Under the current rules, it's £270,000. It used to be a lot less. So the husband or wife do not receive the entirety of the estate. They are entitled to a half of the rest of the estate, but that might not be sufficient for them to live on. And also their children, who may be minors, they're entitled to the other half, the final remaining residue. And that might not be satisfactory either, because they would inherit at 18. And some people say that is too young to be able to manage money. So I've given two examples there where those rules are unsatisfactory, and in those circumstances, a will is absolutely of paramount importance. So what about updating your will? I've talked about the importance of putting a will in place. But the other thing is to make sure your will is up to date. I recommend clients review their wills every 3 years or so, unless there's a situation that's changed. For example, one of the main beneficiaries has died and you need to update the will. So unless there's any sort of supervening circumstances, you should review it at least every 3 years. In the example here, in the photo, the couple in question were partners, so they were living together. That's Martin and Rebecca. And they actually got married last Christmas. So they tied them up last Christmas. Unfortunately, they made a will. Well, unfortunately or fortunately, they made a will before they got married, but they haven't amended it since. The problem here is that if you get married, that revokes the will that you've made before. So a simple solution is for Martin and Rebecca to get in touch with me if they're my clients to rewrite the will. It can be almost the same wording as it was before, but as long as it post-dates the wedding day, as it were, then that will now be valid. So that's an example of a simple solution to a problem. Doesn't come up that often, but I have seen it before, and it's one to watch out for. Moving on to wills that are different to the standard ones. So standard will is really a simple will, giving everything to each other, your partner, your husband or wife, and then on their death, going to the children if you have children. A special will, what I mean by that is a more complicated will. I mean a will which incorporates a trust, which is really like a gift with strings or conditions attached. So instead of A, I'll say person A giving everything to B, person A gives everything to B, but on certain conditions, like they reach a certain age and so forth. The photograph here is that of the late Robin Williams from the USA, who sadly is no longer with us. He was concerned that his family, his children were very young, that they would receive a lump sum on his death and not be able to manage it because they were too young. Obviously, he was a wealthy gentleman, and we're talking about a lot of money. What he did then was not, instead of the standard will, he did a will which included the trust, which I've just talked about. In that way, he was able to protect his children so that when he died, which he did die prematurely, much too young, when he died, instead of the children receiving all of the money at once, they received it in 3 stages. One stage, one slice as it were, when they were 21, the next slice when they were 25, and then the final slice at the age of 30. So that's an example of a special will which fits the precise circumstances, and I have done quite a few of these in the past. The 2 other situations where the special will is useful. First of all, one where the couple I'm instructed are concerned about protecting their money if the survivor goes into a care home or nursing home. And in this situation, by preparing the will in a certain way, by incorporating a trust, like Robin Williams, but a different type of wording, by incorporating a trust, we can achieve wonders here by protecting a share amounting to half of the value of the house, so that it's not included as one of their capital resources if they were unfortunate enough to go into care. So it would be excluded. So just say the house is worth £500,000, then you would in effect be protecting £250,000 by doing this will. Obviously, we need to bear in mind the rules at the time of the local authority that it comes within that. But by and large, I've always found those effective. So it's doing a special form of wording to make sure your house is protected if you then go into a care home, which is very, very useful, and the clients, I find, are happy with that. Thirdly, I'm going to talk about divorce. I've talked about getting married. I'm now going to talk about divorce, and where a will is helpful with these special clauses. If, say, you get remarried and you want to include as beneficiaries the children of your first marriage. Here, a little bit like that will I was talking about just now, to protect your home, you would include a special clause that your partner, your new partner, for example, has the right to live in your home and to get an income from your other assets. And then on her death, the children from your first marriage are included. So in other words, your half share in the relationship is protected. It doesn't all go to your new partner. It is she's entitled to live in the property and get an income, but on her death, your children will be guaranteed that share. So that's another example of a special will, which I can do for you, which protects that situation. Let's move on. What's involved then in making a will? And I've spoke a lot about wills today, but I feel it is important, and it's a good time to mention this. What's involved? So if you're local to us, as I said, we're in Hoylake Wirral, then the easiest thing is to arrange an appointment for me to see you face to face, to take your instructions concerning your wills, and then a second appointment for you to come in and sign the wills. Remember, you do need 2 witnesses to your wills, and so it's important it's done properly. The other thing is that we can do is we can act for you if you live a long way from the office, because we can communicate with you by phone or virtually, send you or send you a questionnaire, a will questionnaire, which contains the information we need to draw up a will for you, and so we can do it that way. And then when it's approved, we can then advise you how to sign it away from the office with the rules about the procedure. So it does work from a distance as well. But as I said, if you're local, it's just convenient if you come in and we can sort it all out. Who keeps the will? Well, we offer that service of keeping the wills for no charge. Some clients don't want to take the will away and keep it themselves. So we offer that service for you. So there's no charges for keeping them. Let's move on to the next slide. So I've talked about wills, the importance of just now wills, of making them in the first place, not putting it off, and updating them where they need to be changed because some event has happened, or that they need reviewing and then changing. Say if there's been a rule, there's been a change in the rules on tax, that means that you should redraw it. Let's now talk about powers of attorney. So this is the situation where instead of a will, you're appointing an executor to manage your affairs on death. This is appointing somebody who's called your attorney to manage your affairs during your life, if there comes a time when you are mentally capable of managing your affairs. What is a power of attorney? It's a legal document in which you give the person authority to handle your affairs, typically your financial affairs. So there are 3 types of power of attorney. There's the enduring power of attorney, which is now obsolete because it's been replaced by lasting powers of attorney. Even though they're obsolete, in other words, you can't use them, you can't create them now. The ones that have been created and signed, they are still valid, so they can still be used if they're in existence. But it's going forward, you can't do new ones. The disadvantage of enduring powers of attorney is they don't include, they're just financial. They don't include a power of attorney in relation to your health and welfare. What about lasting powers of attorney? This is the one that we use now. There are 2 types. There's the one that deals with your financial side and property, including income. And there's the other type that deals with your health and welfare. And I would strongly recommend that you put both in place. Once again, it gives you peace of mind that the person that you appoint, then you can also put in replacements, will be that trusted loved one that will do things properly on your behalf. If you don't do this, so if you, which I see very often, if you don't put them in place, then you'll be relying on the court of protection to appoint somebody for you, and it can take a long time to do that, and it's also more expensive. So whatever you do, please don't rely on that. It's so important to get it in place. So as I said, you've got a financial and property lasting power of attorney dealing with everything financial. You can put in conditions and preferences. You can incorporate that in it if you've got special wishes. And then the other one is dealing with your health and welfare. The health and welfare one is dealing with everything personal about yourself that your loved one will look after, for example, where you're to live, what medication you receive. They can take over everything, everything personal on your behalf. These forms do work well, and once again, I would recommend them to you. The procedure for putting these in place is, once again, taking your instructions either in the office or remotely, then get it signed. We can do that again remotely. Remember, in this case, it has to be signed also by your attorney, so it is a bit more of an involved process, but at least you don't need two witnesses as you do for the will. Then comes the registration process, because they can't be used until they're registered with an office department called the Office of the Public Guardian. There is a fee for registration, and the process takes about 8 weeks to complete. Once again, we tend to keep the originals once registration has taken place, and we can provide you with copies. So once again, any questions about this or the wills that I've talked about, are welcome. We can have a chat. If you leave me your number, my details are going to follow from this shortly. So to conclude, my advice after talking about these matters is to not leave things to chance. It's important to put a will in place now if you've not done so, or to review your existing will to make sure it's up to date, and again with lasting powers of attorney to put those in place if they've not been done. Don't leave it to chance. Do it now when you're fit and healthy, rather than later when maybe you're not capable of doing it. So thanks very much for listening. I know it's been, it is quite morbid, some of this material, but I'm hoping that if you get it in place, that if you take stock of what I've said, that will also make you feel better and give you peace of mind. Here are my details about making an appointment. You've been very patient, and thank you very much for listening. Well, that is quite long.